going to be a review of our Elliot two-wave fib pullback system. And it's a very simple system. First, you find a strong trend, which you can clearly see in the euro-dollar. It's been going down, the daily trend's down, the weekly trend's down. Most of the momentum moves are at and above the 80 line, which we consider significant. And once it finally finds a low, basically the Elliot two-wave system, once it goes up one wave, you draw your fibs on it. You'll find some of the trades work, some of them don't. When it gets to the first or second fib target, then breaks down right here, you go short. So you'd be short at 67 here, and then your stop, in this case you get stopped out with a small less than 10 pip loss. And one of the rules to this is when you look for this first or second fib target to get hit, it should be underneath the hourly moving average if you're going to look to sell. And if you find a strong currency that's going up after the two-wave pullback, it should still be at or above the hourly moving average. So the first one you see today, you can see was a loss. Let's take a look at the pound dollar. This one made a big move down, lots and lots of weakness. Here's your first wave up, and it has to be at least 15 to 25 pips. It hits the first and second fib target. I kind of want to wait for it to go short right here at 88, and you can see it fell all the way back to 50. But even if you got out of it somewhere around 70 right here, you can see you quickly made 18 pips, and you might have lost 8 to 10 pips on the first one. And notice that this one, when it came up to the first and second fib targets, underneath the hourly moving average, which is in the middle. If you're not familiar how to add that to your charts, you just simply add the containment bands, and that will put that gray hourly moving average in the middle. Here's a very strong trend, and in fact it's so strong it goes above our upper containment bands. Draw your fibs on there, and again, I prefer when the second fib level gets hit, and you really want to wait for it to go above the previous bar's high before getting long. In some cases it goes down to the 2.0 level, and it's quite easy to spot these trades on a range chart. Here is a 6 pips per bar euro-dollar chart, and you would basically at that level wait for it to go above these bars, and you might actually have gotten into that trade right there. I always put my stop a pip or two underneath the low, and then unfortunately you have a small loss. You have to get right back in. Losing is having losing trades is part of trading, and when you get in the second trade at 102.75, you can see it came all the way up to 103, 103.05. So it went up over 25 pips. If you lose 6 to 8 pips in the first one and make 25 on the second, you're left with a profit. And later in the day, you can see the same exact pattern happen. A little pullback here, wait for it to go up. You put your entry level right here at 85, your stops underneath the low, and this starts going up. And you can really spot this on the way down. Extreme weakness. In fact, it appears more intensity than previously, and it wasn't as much of a pullback as before. When it starts going up and it has less strength than the previous weakness, typically you want to move your stop to break even once it moves up 10 pips. So, or at least move it close to break even. So you wouldn't have lost more than 3 or 4 pips in that example. Another very strong currency on the way up. And this isn't really much of a pullback. It's pulled back maybe 10 or 15 pips. This is a more volatile currency, so I'll typically wait for a little bit bigger swing. And here's the low. You can see it starts going back up. Here's the second wave down. 122.52 is where it stops. Here is a 6 pips per bar range chart of the same currency. And on this, when you see it coming down, range charts, one of the entry methods I use is 4 to 5 red bars. As soon as it goes green, buy it when it goes a pip above it. You can have very, very tiny stops. You're risking 6 pips, which is a range bar chart, plus a pip here, a pip there, and spread. It's 10 or 12 pips on a very volatile currency. And you can see it shut out from about 122.58 all the way up to 86. So at least about a 27 pip move up. So you can see if you lose 6 to 12 pips, even twice, and you have one nice win, you're break even. If you have one loss and one win, then you're winning. If on some days you'll see this has a very high winning rate, you have mostly wins. Let's go to the next example here. This is also a very explosive move up, and it always helps when the daily, weekly, monthly trend's up. Draw your fibs on there. Notice it stopped right at the second fib target. That you'll find that happens the majority of the time. Usually when the currency's up too much, it pulls back a lot of times close to the hourly moving average here. And so 83.40 pulls back, and notice it goes all the way back up to 80.85. It's a 45 pip move up. So again, it only takes one nice 25 to 40 pip win to get rid of, 2 or 3 losses. Here's the New Zealand yen. Try your fibs on there, and again, notice where it went, right to the 1.618. A lot of times when I'm trading, I don't teach this that often, but I'll take the trade. If it comes down and stalls at the 1.618 and starts going up, I get in. Or if it breaks through it by a few pips, as soon as it goes back above this fib level at 83, maybe I'll buy at 84. I'm going to put my stop right underneath the low at 79. Ultra tight stop, and you can see this quickly went up 15 pips, and then it also went up another 20 pips after that. Here's an example of why I have the rule in there that primarily focuses on selling a currency when it stays underneath the hourly. So in this example, if you drew your fibs on here, here's the first and second fib target, but it has broken above the hourly moving average, which is actually a sign of strength. And you can still get in that trade, have a loss, wait for it to get to the 2.0 level. Obviously, if you got back in here and it pulls back 20, 30 pips, you got your loss back. But your odds of winning are less when a weak currency goes back above the hourly. There was another one today that did the same thing, I believe, in the Australian dollar. Notice it goes above the hourly. And so if you had shorted right here, guess what? You lost. If you got back in it again, you made money, and when it came back and had a false breakout from below to above the hourly and broke down right here, you made money. And obviously the hourly moving average is a significant resistance here, and that's why we put on the chart. When it came back up to this area here, couldn't get above it, had almost a third less strength than the weakness before. That's another good trade there as well, but that's a totally different system. But the rule is, and sometimes when currencies are so weak that they're 20, 30 pips underneath the lower white band, when you get a two-wave pullback, usually at that point it is underneath the hourly moving average. In this case it wasn't, and that lowers your odds.